Hello my friends, welcome to my Energy Economist channel. We're gonna talk today about the types of contractual oil regimes. So stay with me. In the late 1940s and the early 1950s, there was a marked change in the political and economic conditions of most third world countries. There were some fundamental transformations in the entire world economy, which set the stage for the beginning of a new era. In this post-war period, significant changes were also apparent in the international oil industry and the nature and terms of oil contracts, which had already been the subject of a vigorous nationalization in Mexico 1938 and which were facing similar attempts in Iran 1951 and much later in Iraq 1968-72. The significant characteristics of this period, 1950-72, were the transition and transformation of the entire industry from the status of a cartel-like economic entity based on the administered pricing decisions, demand management, and the supply manipulation, to a world industry with an emerging unified competitive market and prices that were subject to the regulation of a more developed form of capitalism on the world scale. As expected, in periods of transition such as this, one may find an assortment of fading elements of the old along with the embryonic but nevertheless developing constituents of the new. Some of the more distinct characteristics of this period were the existence of long-term contracts, the establishment of the Persian Gulf basic point system and subsequent designation of lower posted prices for its oil, the utilization of posted prices for the calculation of oil royalties and rent, and the formation of OPEC. In this period, the control of oil was founded upon a double pacing point system, one associated with the cost of production of oil at the Gulf of Mexico, and another based upon the cost of oil in the Persian Gulf. It's true that initially the IPC engaged in posting one price for both these oil-producing regions. But as the Persian Gulf oil entered the markets in the Western Hemisphere and tended to displace US oil, the IPC was obliged to cut the posted prices, thereby admitting openly but indirectly an enormous margin of profitability in the IPC's Middle East operations. Paradoxically, however, cuts in the Persian Gulf basin point posted prices led to an accelerated displacement of Western oil by its Middle Eastern counterpart. During this period, the long-term colonial contracts had remained intact, and there was neither a spot market nor, for that matter, a futures market in crude oil. Contrary to the previous period, the calculation of the oil royalties rents in this period was based upon posted prices rather than a fixed sum of money per barrel of oil. Therefore, the magnitude of oil royalties rents was calibrated according to the variability of posted prices, which is theoretically a tangible step toward a price-determined economic rent in the oil industry. With further transformation of the industry since 1974, given the emerging global spot markets and the globalization of the oil industry, posted prices became fully dependent on the magnitude of competitive prices in the market, and so as the oil rents. Finally, only after the establishment of the regime of 50-50 profit sharing, which was directly dependent on posted prices, a mechanism of appropriation of the oil rents, did the oil exporting rentier states become interested in the magnitude of the posted prices. The higher the posted price, the larger the amount of oil rent due to be appropriated by the oil exporting nations, OPEC and non-OPEC alike. The formation of OPEC prompted by a unilateral reduction of the posted price in the Persian Gulf oil region. This reduction led to a steep decline in the magnitude of oil royalty collected by the oil exporting countries in the region. Similarly, there was a simultaneous reduction in the posted price of Venezuelan oil. And this was a trigger behind the joint protest by Venezuela and the other 4 Persian Gulf oil producers manifested in the first meeting of OPEC in the fateful September of 1960. During the second half of the 20th century, and with the political developments around the world, the concessionary regime came to be regarded as incompatible with government sovereignty. Contractual regimes emerged as a result of efforts to modify the nature of the relationships between IOCs and host governments, and above all to find an alternative to the concessionary regime, allowing the host government, in theory, to exercise more control over both the petroleum operations and the ownership of production. 2 types of contractual regimes apply: production sharing contracts, PSCs, and risk service contracts. The concept of the PSC was used firstly as early as 1950s, but in their currently used form, PSCs in particular became popular in Indonesia in the 1960s. Risk service contracts first came into use in the late 1960s. Under the typical contractual systems, the oil company is appointed by the government as a contractor for operations on a certain area. The title to the hydrocarbons remains with the state, and oil production belongs to the government unless it's explicitly shared, while the IOC executes petroleum operations in accordance with the terms of the contract and operates at its own risk and expense under the control of the government. The IOC also provides all the financing and technology required for the operation. The 2 parts agree that the contractor will meet the exploration and development costs in return for a share of production, or a cash fee for this service if production is successful. If the company receives a share of production after the deduction of government share, the system is known as a PSC, also known as a Production Sharing Agreement (PSA), which is a binding commercial contract between an investor, the IOC, and the state or national oil company. A PSC defines the conditions of the exploration and development of natural resources from a specific area over a designated period of time. Under a PSC, as the company is rewarded in physical barrels, it therefore takes title to the share of petroleum extracted at the delivery point, export point from the contract area. If the IOC is paid a fee, often subject to taxes, for conducting production operations, the system is known as a service contract, also called a risk service contract. The latter is so called because the host government or its national oil company hires the services of an international oil company, and in the case of commercial production from the contractual area, the oil company is paid in cash for its services without taking title to any petroleum extracted. A distinction is sometimes made between service contracts and risk service contracts. The former is simply based on defined compensation for a specific task, while the latter may involve additional risk being taken by the contractor for which a variable fee may be applicable. While some service contracts are disguised PSCs, especially with regard to ownership of the resource, the main differences between the 2 contract forms are the remuneration of the contractor and the control over operations. Over time, PSCs have changed substantially, and they now take many different forms. One can refer, for instance, to a typical Asian or a typical Eastern European contract. Terms vary between one country and the other. But in its most basic form, a PSC has four main properties. The IOC pays a royalty on gross production to the government if applicable. After the royalty is deducted, the IOC is entitled to predetermined share of production for cost recovery. The remainder of the production, so-called profit oil, is then shared between government and IOC at a pre-specified share. The contractor then has to pay income tax on its share of profit and cost oil combined. After deductions permitted under tax law, a few systems, Angola, Russia, have used profit oil alone as a base for income tax. In contractual regimes, as with concessionary systems, the oil company bears all the costs and risks of exploration and development. It has no right to be paid in the event that discovery and development don't occur. However, if there is a discovery, the company is allowed to recover the costs it has incurred, and this is known as cost recovery or cost oil. The investor typically may take oil for cost recovery up to a fixed proportion of total production from the subject, known as the cost oil limit, as compensation for the cost of exploration and development. The oil that remains after the oil company has taken its cost oil is usually termed profit oil. Cost recovery is similar in concept to deductible expenses for tax purposes, including depreciation of capital assets under the concessionary systems. It includes mainly unrecovered costs carried over from previous years, operating expenditures, capital expenditures, abandonment costs, and some investment incentives. Financing cost or interest expense is generally not a recoverable cost, though unrecovered costs can often be rolled forward with an uplift in lieu of interest. Normally, a predetermined percentage of production is allocated on a yearly basis for cost recovery. However, in general, there is a limit for cost recovery that typically ranges from 30 to 60% of gross revenue. In other words, for any given period, the maximum level of costs recovered is 60% of revenue. Although contracts with unlimited cost recovery are also in existence. See Indonesia, Bahrain, and Algeria, for instance. A fixed ceiling on cost oil ensures a minimum quantity of profit oil from which the state can secure upfront revenues as soon as production commences. Many PSCs specify annual cost oil allowances either on a sliding scale or state that this variable is biddable or negotiable up to a certain maximum value. Full cost recovery occasionally comes with a time limit attached to it. The share of production set aside for cost oil may decline after, for instance, 5 years, in which case it works similarly to accelerated depreciation. Unrecovered costs in any year are sometimes but not generally carried forward with interest to subsequent years. Investment incentives, credits, uplift, or allowances may also be provided to allow the contractor to recover an additional percentage of capital costs through cost recovery. The more generous the cost recovery limit is, the longer it takes for the government to realize its take. There is usually a ring fence for cost recovery around the contract area or development area costs associated with a particular block. All licenses must be recovered from revenues generated within that block or license. Royalties can also feature in PSC regimes, but the same economic impact can be secured by having cost oil limits below 100%, together with minimum state profit oil share, which also ensure an early flow of revenues to the state. The principle of cost recovery applied to post PSC and in risk service agreements. However, the basis of the contractor's remuneration after it has recovered its cost differs in type. In a PSC, profit oil is divided between the host government and the company according to a predetermined percentage negotiated in the contract. The split can be constant or on scale linked to cumulative or daily production rates, or there can be a progressive split linked to achieved project profitability, that is, to rate of return ROR or R factors. If you want to learn more about the types of contractual oil regimes, you could do so in my book, Economic Study of Oil and Gas Exploration, which is published on Amazon. Check it out at the link in the description. Please take a second to hit the like button, hit the subscribe button, and don't forget to also hit the notification bell. Thank you for watching and goodbye.